I hope you're fully caffeinated. In the next 3 minutes, we're going to cover consumer price index, inflation rates, joblessness, and then, of course, our local inventory and real estate market. This week we had two big announcements. The first one was the consumer price index, which showed inflation is actually a little bit higher than economists thought it was at its already high rate. And then we had our announcement of our jobless claims. Let's talk a little bit about inflation though. Inflation is too many dollars chasing too few goods. So when people have money in their bank and want to buy items and items aren't there, and you see this every time you go to a restaurant and you see a help wanted sign everywhere. The last leg of definition saying that we're absolutely in a recession that we need to see is the unemployment rate. So the unemployment rate has been really low, which has caused our inflation to continue to go up. And what we're starting to see now, we had the next announcement this week showing that the early jobless claims is actually higher than expected. So above average joblessness just came out for the first time. This is a big deal because we're not going to get relief on our Fed rates or our inflation rates, ultimately on our mortgage rates, until we see joblessness. Because right now, again, we have too many dollars chasing too few goods. So with the jobless claim coming out, there is light at the end of the tunnel that, hey, we can go through a period with a little bit of unemployment, get through this recession, have it bottom out, and then have rates come back down to then create more employment and cause our low mortgage rates that we all know and love. With that being said, what has happened in our local real estate market here in the last few weeks is with the previous rate hike and current mortgage rates sitting between 6 and 7%, we've seen demand go down. So the number of buyers who are making offers and offers being accepted has come down significantly. In the last month, we've seen 13.25% decrease in the number of homes that are currently in escrow, with our inventory going up a little bit, which is not normal this time of year. And so we're sitting right now with about 3,600 homes on the market active in all of Orange County. For perspective, at our absolute highest peak in March, we had 1,504. And at that time, we had 2,835 pending properties in all of Orange County. Today, we have 1,859 homes currently in escrow. That's a pretty significant drop. And so what we're seeing, 3,600 homes, by the way, active isn't a huge number. It's still in the category where we would typically see a seller's market here. But because our demand is so low by the lack of affordability driven with the high interest rates, we're seeing things sit a little bit longer, and you need to get creative when selling your home and really make sure that you're getting an A in all of the areas for how you've prepared the property for market, how it's staged, how it's photographed, marketed, presented to buyers, and then ultimately how we can accommodate making the home affordable again. We've got some great strategies with creative financing, buying down mortgage rates, and doing some other things to cause affordability to go up for the buyers and allow them to pay the high prices. Because today, after the last 5 years of the market we've been in, buyers typically are willing to pay high prices. They're just more concerned about their payment. So if we give them a payment option that's lower, market your home appropriately, and really do all of those things correctly, you're still going to get a great price in this market. If you have any questions about what's happening in the economy, joblessness, consumer price index, and mortgage rates, give me a call. I'd be love to help you guide through this choppy waters that we're in right now. Can't wait to talk to you soon.